Hello everyone. In this video, I will be introducing you all to the concept of decentralized finances, or in short, DeFi. First, I would like to introduce myself. I am Anushka, a third year BTech student from Bennett University. Bennett University is a state private university with the aim of providing Ivy League quality of education to undergraduate and postgraduate students, making them life and career ready. The vision of the university is to become a center of excellence comparable to the Ivy League standards, helping define aspirations and possibilities for the long term and producing life and career ready professionals with leadership quality who are ready to challenge and be challenged. Let's talk about what is DeFi. DeFi is an open and global financial system built for the internet age, an alternative to a system that's opaque, tightly controlled, and held together by decades old infrastructure and processes. It gives you control and visibility over your own money. It gives you exposure to global markets and alternatives to your local currency or banking options. With DeFi, the markets are always open and there are no centralized authorities who can block payments or deny you access to anything. Services that were previously slow and at risk of human error are automatic and safer now that they're handled by code that anyone can inspect and scrutinize. In centralized finance, the government has the right to control the money. They can print as much as they want, charge taxes, and even make laws that may or may not affect your money management structure. International transactions are heavily taxed. Loans are given at higher rates, and you are even checked if you move a large sum of money from one bank account to another. This can be called a traditional way of financing. In DeFi or open financing, a term coined by the group of entrepreneurs and Ethereum developers, the major advantage is that it was made to remove any intermediaries for transactions. In this case, banks and the government. This would allow transparency, security, and speed with which the transaction occurs. This is accomplished through peer-to-peer financial networks that use security protocols, connectivity software, and hardware advancements. There are many benefits of DeFi. Some are: it is open. You don't need to apply for anything or open an account. You just get access by creating a wallet. It is pseudonymous. You don't need to provide your name, email address, or any personal information. It is flexible. You can move your assets anywhere at any time without asking for permission, waiting for lock transfer to finish, and paying expensive fees. And last but not the least, it is fast. Interest rates and rewards often update rapidly, as quickly as every 15 seconds, and can be significantly higher than traditional Wall Street. So, what's the story behind decentralized finances? Let's start from the beginning. The first of them was the creation of Bitcoin in 2009 by Satoshi Nakamoto. Despite whether Bitcoin should be classified as DeFi or not, its inception was the key enabler for the whole cryptocurrency industry, which decentralized finance is part of. Bitcoin also allows for sending payments around the world in a decentralized fashion, and payments is one of the area of finance. Looks like DeFi to me. But most importantly, Bitcoin enabled the creation of Ethereum, a default blockchain for all top DeFi protocols. Although sending Bitcoin around the world is cool, finance doesn't stop there. Every robust financial system needs a set of other important services, such as lending, borrowing, trading, funding, or derivatives. Bitcoin, with its simple and limited language called script, was just not suitable for these kind of applications. Script's limitations were one of the most important factors that contributed to the creation of Ethereum by Vitalik Buterin. Ethereum launched in 2015 and quickly started attracting more and more developers who wanted to build all kinds of decentralized applications, ranging from games such as CryptoKitties to financial applications. Ethereum, with its Turing complete programming language, Solidity, and the ERC20 standard for creating new tokens, quickly became a go-to smart contract platform to build on. This leads us to one of the oldest DeFi projects on Ethereum, Maker. Maker is a protocol that allows for creating a decentralized stable coin, DAI. The process was formed in 2014 by Rune Christensen, who was inspired by another project BitShares, a blockchain created by Dan Larimer. Development of Maker was funded by venture capital and was eventually launched at the end of 2017. The first iteration of the protocol, single collateral DAI, supported only ETH as collateral. This was later expanded to multi-collateral DAI that was launched at the end of 2019. Maker remains one of the most important projects in the DeFi and is clearly one of the early pioneers of the whole decentralized finance space. Also during 2017, one of the first big use cases for Ethereum ICOs became prevalent. New projects, instead of raising money using traditional methods, started offering their own tokens in exchange for ETH. Although the idea of decentralized fundraising was not bad in theory, it resulted in multiple overhyped projects raising way too much money without anything to show besides a few pages of a white paper. In the plethora of ICOs, there were also a lot of projects that we had classified as DeFi. One of the main breakthroughs at that time was the idea of users interacting with smart contracts containing pooled funds with multiple users rather than interacting directly with other users. This basically created a new user to contract model that was more suitable for decentralized applications as it didn't require as many interactions with the underlying blockchain as the user to user model. Decentralized finance uses the blockchain technology that cryptocurrencies use. A blockchain is a distributed and secure database or ledger. Applications called dApps are used to handle transactions and run the blockchain. DeFi uses cryptocurrencies and smart contracts to provide service that don't need intermediaries. In today's financial world, financial institutions act as guarantors of transactions. This gives these institutions immense power because your money flows through them. Plus, billions of people around the world can't even access a bank account. In DeFi, a smart contract replaces the financial institution in the transaction. A smart contract is a type of an account that can hold funds and can send refund them based on certain conditions. No one can alter that smart contract when it's live. It will always run as programmed. A contract that's designed to hand out an allowance or pocket money could be programmed to send money from account A to account B every Friday, and it will only ever do that as long as account A has the required funds. No one can change the contract and add account C as a recipient to steal funds. Contracts are also public for anyone to inspect and audit. This means bad contracts will often come under community scrutiny pretty quickly. DeFi applications give users more control over their money through personal wallets and trading services that cater to individuals. But while taking control away from third parties, decentralized finance does not provide anonymity. Your transactions may not have your name, but they are traceable by the entities that have access. These entities might be governments, law enforcement, or other entities that exist to protect people's financial interest. Some of the ways people are engaging with DeFi today are: number one, lending. Lend out your crypto and earn interest and rewards every minute, not once per month. Number two, getting a loan. Obtain a loan instantly without filing in paperwork, including extremely short-term flash loans that traditional financial institutions don't offer. Buying derivatives. Make long or short bets on certain assets. Think of these as the crypto version of stock options or future contracts. Trading. Make peer-to-peer trades of certain crypto assets as if you could buy and sell stocks without any kind of brokerage. Number 5. Saving for the future. Put some of your crypto into savings account alternatives and earn better interest rates than you typically get from a bank. Peer-to-peer financial transactions are one of the core premises behind DeFi. A P2P DeFi transaction is where two parties agree to exchange cryptocurrency for goods or services with a third party involved. To fully understand this, consider how you get a loan in centralized finance. You had need to go to your bank or another lender and apply for one. If you were approved, you had to pay interest and service fees for the privilege of using that lender's services. Peer-to-peer lending under DeFi doesn't mean there won't be any interest and fees. However, it does mean that you will have many more options since the lender can be anywhere in the world. In DeFi, you had to use your decentralized finance application to enter your loan needs and an algorithm which match you up with peers that meet your needs. You had need to agree to one of the lender's terms and receive your loan. The transaction is recorded in the blockchain. You receive your loan after the consensus mechanism verifies it. Then, the lender can begin collecting payments from you at the agreed upon intervals. When you make a payment via your dApp, it shows the same process in the blockchain. Then, the funds are transferred to the lender. DeFi is designed to use cryptocurrency for transactions. The technology is still developing, so it is difficult to determine precisely how existing cryptocurrencies will be implemented, if at all. Much of the concept revolves around stablecoin, a cryptocurrency backed by an entity or pegged to fiat currency like the dollar. It is a tokenized version of the asset and can be introduced subtly into a blockchain ecosystem to facilitate seamless past transactions, improved arbitrage, and value exchange. It is sometimes referred to as a utility token because it allows you to quickly buy and sell on decentralized exchanges that do not accept fiat currencies. Stablecoins are also used in centralized exchanges. What makes them useful in an exchange of this kind is the fact that fiat currencies take a long time to process, but their tokenized counterparts are standard blockchain entities that move quickly. Some notable advantages are they can be used as an everyday currency. Unlike traditional crypto coins, which are subject to price fluctuations and volatility, stablecoins do not fluctuate much because they are backed by national currencies. In addition, they have the same advantages as other crypto coins: blockchain security, transaction anonymity, quick transfers, and the lack of intermediaries. They can be used to pay for groceries, fares, or electricity bills, among other things. Number two, great potential for smart contracts. Smart contracts are frequently based on other cryptocurrencies, such as Ethereum. Frequent price changes can have an unpredictable impact on the contract's terms. The use of stablecoin like Tether can provide contract stability to both parties by reducing market volatility and ensuring that more secure contracts are enforced by the blockchain. Decentralized finance is still in the beginning stages of its evolution. For starters, it is unregulated, which means the ecosystem is still riddled with infrastructural mishaps, hacks, and scams. Current laws were crafted based on the idea of separate financial jurisdictions, each with its own set of laws and rules. DeFi's borderless transaction ability presents essential questions for this type of regulation. For example, who is responsible for investigating a financial crime that occurs across borders, protocols, and DeFi apps? Who would enforce the regulations and how would they enforce them? The decentralized finance ecosystem's open and distributed nature might also pose problems to existing financial regulations. Other concerns are system stability, energy requirements, carbon footprints, system upgrades, system maintenance, and hardware failures. Many questions must be answered and investment made before DeFi becomes safe to use. Financial institutions are not going to let go of one of their primary means of making money if DeFi succeeds. It's more than likely that banks and corporations will find ways to get into the system, if not to control how you access your money, then at least to make money from the system. Hence, to conclude, decentralized finance is equipped to fundamentally change the world economy, with blockchain technology spearheading the front. Decentralization is set to bring back privacy, trust, and let individuals create a future where a transparent, secure public system is in control once again. DeFi will enable the unbanked to join the economic system. It will lower the cost of doing business and it will offer new investment opportunities for anyone across the globe. It will empower individuals and organizations and make them less reliant on the too big to fail financial institutions that brought chaos during the Great Recession. The future is decentralized, and that certainly applies to the financial sector. Thank you for watching this video. Hope you learned something useful about decentralized finances.